Don't just assume that where you live in terms of taxes is efficient. I'll give you an example of a comparison between the United Kingdom and Singapore. So I live in Singapore and I used to live in the UK. I've got businesses all over the world and I chose to move to Singapore. Not just because of tax reasons. I pay tax in Singapore. I could have set up somewhere where there's zero tax. There's plenty of countries that offer zero tax. You can go to Dubai, register a business in the Dubai International Financial Center, the DIFC, put all your sales, all your revenue, all your profit through your Dubai company and pay zero for 50 years. Now that's fine if you don't want to live there. If you actually want to live there, what's the important thing is, what deal do you get in return for the tax that you pay? Well, if you pay nothing in these countries around the world, what you find is, in return, you do get nothing. So go to any of the Caribbean islands where you can set up companies and pay 0% tax. What do you get? Dirt roads, no schools, no hospitals, just crap public services. You can't live there. They're just tax havens, right? So it's different if you actually want to move there, okay? So I think Singapore is the best place in the world because it's the best deal in the world in terms of tax efficient structures and lifestyle. So let's say you have a service company and you work for yourself. And you have a UK company and a Singapore company. And you invoice a client 100. In the UK, what ends up in your pocket if you have a gross margin business of 50%? If you're the entrepreneur, what ends up in your pocket? Out of 100, with a 50% gross margin business. Anyone have a guess? Who said 55? You've obviously not ever worked for yourself in the UK. Who's self-employed in the UK? What do you think you get? 40? No, nowhere near. Try 12. Because what's happening, you invoice 100, right? Your VAT is 20%. Sales tax. If you're on a 50% gross margin business, you claim 10 back. So you're left with 90. Okay? Then you're 45 because your gross margin is 50%. Then you pay your corporation tax 20. So what are you left with? 36. You leave 10% in the business. You can't take out all that 36. If you have a bad 1 or 2 months in the next quarter, you need to have working capital in your business at all time, right? So you leave in 10 all the time. So you're left with 25, 26. Then you pay yourself. Now let's say you're a higher rate taxpayer. You've got a very successful business. What's the highest rate of income tax in the UK? How much? 45. Is it 45 now? What's national insurance? 13. I thought it was 11. 12. Okay. I don't know, I've not been here for a while, but it's not gone down, right? And by the way, one of the costs of the business in the UK is that you actually have to pay employers' national insurance. So whoever you hire, you add it on, you have to write a check. It's a tax on jobs. It's crazy. So you're left with your 25, 26. You're a high rate taxpayer, 45% tax plus 12% national insurance. So you're at 57. You're left with 12, 13. Now that is a fucking good business. That's a 50% gross margin successful company with a product or service that sells. And the owner is in the higher income tax bracket because they're earning a few £100,000 a year or whatever, right? What if you're